Are you confused about all the information out there about mortgages, interest rates, and loan programs? What if you had all the important knowledge that you need to make an informed decision on your new mortgage and the home buying or refinancing process? In today's video, I'm going to show you everything that you need to know, start to finish, to understand the basics of different mortgage programs, how they work, and the entire process of getting a mortgage in today's market. Check it out.
What are the 4 factors that go into a mortgage payment?
All right, so 4 factors. You got your principal, interest, taxes, and insurance. And the insurance would entail property insurance, flood insurance, as well as PMI or mortgage insurance. So let's talk about that for a second. The escrow, the taxes and insurance are only going to be there if you are putting less than 20% down or if you're using a FHA loan. They're required in those circumstances.
What are the different types of mortgage products that are available?
The first one's going to be your fixed rate mortgages, then adjustable rate mortgages, FHA loans through the Federal Housing Administration, VA loans through the Veterans Affairs, and USDA loans through the U.S. Department of Agriculture. So like I said, fixed rate never changes. Adjustable rate is going to be fixed for an initial amount of time, and then it's going to adjust every certain amount of time. FHA is a government loan. It's backed by the Federal Housing Administration. Great loan, especially for first-time home buyers. And one of the reasons is it's very forgiving when it comes to credit, has down payments as low as 3.5%, even on multifamily homes, which is very rare. The VA, like I said, Veteran Affairs loan, probably the best loan program in the country, but it's only for veterans and their spouses, so not anyone can get it. The reason why it's so great is no down payment required, 100% financing, no PMI, there's no mortgage insurance on a monthly basis. Then the USDA, like I said, U.S. Department of Agriculture, great loan program, no money down as well, but there's certain specifications you have to meet for that loan. So one of them is going to be, it's only for certain areas, mainly rural areas. Also, there's an income limit. So if you're someone that makes more than a certain amount of money, depending on the area, you're not going to be able to get that loan. It's more for underserved types of communities. So there's a limitation on income.
How is affordability calculated in regards to a new mortgage payment?
Affordability is really looking at how much can you afford versus your income. So mortgage companies and lenders are going to use something called DTI. That stands for a debt to income. It's a ratio. It's a calculation that we'll be looking at, which is your total monthly debts and your total gross income. And how much does that entail? So there's a front-end debt ratio and a back-end debt ratio. The front-end ratio is just what your housing expense is. So that'd be your primary home, mortgage payment, property taxes, insurance, PMI if it's applicable. That's the front-end ratio. And then the back-end ratio is all of your debt, your student loans, your car loans, medical bills, anything that you're paying on a monthly basis, credit card debt, etc. That's all going to be looked at as far as what's your minimum monthly payment on those versus your gross income.
You can just explain what amortization is and how it relates to different mortgage terms.
Sure. So an amortization, the definition is it's a repayment schedule over a period of time. It's going to show you how much money is going to interest versus how much is going to principal. When you take out a mortgage, you're actually going to get an amortization schedule from month 1 all the way till the end of the mortgage, how much is going to interest and how much is going to principal, escrow, etc. Okay?
So what are the advantages then of taking an adjustable rate mortgage over a fixed?
Well, we need to look at the question, how do adjustable rates work? So the reason why adjustable rates can be attractive is because they typically have lower interest initially. They are higher risk long-term. So for example, if a 30-year fixed mortgage is at 4% and a 5-year adjustable rate or a 5/1 ARM is at 3.25%, well, if you knew that you were going to sell that house in 3 years, then wouldn't it make sense to take that lower rate?
Rob, can you just maybe go over the steps really quickly during the mortgage process?
The first step in the process is going to be that initial application, that initial inquiry with a mortgage advisor or lender. The next step, once we do that, is we're going to come back to you with like a pre-qualification. At that point, we're going to collect all your documents. Super important. Now, in the case of buying a home, That next step is going to be, we're going to issue that letter to you or your realtor to say, here's how much home you can afford. Now you can get out there and start looking at properties. So you're going to be going through negotiations and looking at homes and surfing the net and talking to your realtor about that stuff to kind of see what home you're interested in. Then they're going to do some negotiating. You're going to get a contract accepted. You're going to have a contract signed. That's when we move forward to the underwriting process. We order the appraisal and that sort of thing. The underwriter reviews all your documents, sees if there's any other questions or concerns that come up. Then we clear the conditions on the loan, which are the questions or concerns the underwriter has, additional documents that may be needed. We're going to process all that information and all that documentation, send it back to the underwriter for final review. Then they're going to issue the clearance for closing. That's when we can move forward with the actual scheduling of your closing, reviewing all the final documents, you sign the final paperwork, and we wire the funds to your attorney or title company to actually fund your loan and get you the money that you need to buy or refinance your home. Hopefully now you see that mortgages really don't have to be scary if you understand the process and you're working with a real pro mortgage advisor to help walk you through. If you found value in today's video, go ahead and hit subscribe. Also click the bell so you get notified on all of our future content. If I can be of assistance to you or anyone that you know, I'm licensed in the entire states of Massachusetts, Connecticut, and Florida. You can reach me by call, text, or private message at 860-413-3938. Hope that helps, and we'll talk to you soon.